One of the most difficult tasks when it comes to passing a prop firm challenge is basically having a profitable strategy that actually see you through the whole process. Because when it comes to trading prop firms, your strategy is very important. Just like trading a normal trading account, strategies are very important. And in this video, I'm going to share with you a simple strategy that I personally have been trading since I started trading that has actually helped me pass multiple prop firm accounts. Yes, you heard me right. I've got funded with different prop firm accounts and I've been trading the same strategy over and over again. And this strategy is very simple and easy to follow because all you basically have to do is that identify the trend, identify your key level, and wait for your entry. As simple as that. You don't have to draw tens and thousands of lines. All you basically need is simply one level identified and then patient, and you're basically good to go. So now with this already said, without taking much of your time, if this is your first time here, help me do the YouTube business by smashing on that subscribe button. Also like this video so that YouTube will actually recommend it to other people who are into the trading industry and also looking forward to be profitable. Now with this already said, let's get straight on my laptop. Let me take you through a practical step on how this strategy actually works and also show you some evidence of trade I personally have taken with this strategy, from backtesting to real-time trade that I recorded and have in stock. So let's get started. So guys, now that we're on my laptop, and before we even get started, let me just show you through this strategy. So now this particular strategy is what I've been using since, let me just say, since I got into trading. This is what I've been learning and been using. It has given me way more wins than losses. And the benefit of this strategy is that what it gives you a high win rate, whereby your minimum target could be a 1:3 and above, and that makes it one of the most perfect things ever to get. However, this is not a holy grail strategy because it also has its flaws. So I'm going to let you know the truth before we even get started to the strategy itself, because I'll need to let you know that well, using this strategy doesn't mean you are going to win all of your trade. You are definitely going to fail some. As you can see here, I failed some, but I won more. That is the most important thing. And secondly, you can see that well, this strategy is fully back tested with a lot of evidence here. You can see the wins are always more glittering than the losses. Now let's get straight on the chart. Let me actually use a real-time market to show you how this strategy works and explain every single thing you need to understand. Now when it comes to trading this strategy, there are basically 3 steps. The first step is that we need to identify the market trend. Now to identify the market trend, first of all, let's take a look at this pair here. This is Chef JPY. I personally don't like trading this market. I've already analyzed my favorite market and I'm waiting for my trades to be triggered. That's why I'll be using this particular one as an example. I don't like trading it because it's kind of too slow to me. I like highly volatile pair, but Chef JPY doesn't seem to be moving in that direction for me. But that's what I'm going to use for this tutorial's sake. So now remember, the first thing I said was what we identify the market trend. Now when we are looking at the trend, we are looking at the current market position based on the time frame we are trading. So you can be trading the 4-hour time frame, the 1-hour time frame, the 30-minute time frame. It doesn't really matter, because I personally use this strategy on the 4-hour, 30-minute, even on the 15-minute when it's demand me to actually do that. So but for this video, I'm going to use a 4-hour time frame to make everything more clear and simpler. So now first of all, let's take a look at this chart here. Looking at the current market movement, we can all see that well, this market is actually a downtrend. We can see clearly that well, the market is actually a downtrend. Looking at the pattern is printing at this other side here. Now once you see that it's a downtrend, first of all, we need to identify the point whereby it creates this downtrend, and we can see clearly that what here is a low, a high, and then a low, a high, a low, a high, low, high. So we can clearly see that the market is creating what? Lower lows and then lower highs, going downwards gradually. So with this sort of evidence and seeing that this map is actually facing downwards, we all conclude that the market is a downtrend. Now since the market is a downtrend, as they always say, what? The trend is your friend, so always trade in direction of the trend. So since this market is a downtrend, we have to look for only selling opportunities. Now remember what I said, we've identified the market direction, which is the first thing I said is simply for you to trade this strategy, first of all, you need to identify the trend. And in this scenario, we've identified the trend and it has proven that what? It's a downtrend, so we are looking for selling opportunities. Now since we are looking for selling opportunities, as a supply and demand trader, we only look out for supply levels, meaning we are not interested in looking for demand as the market stand. So we are only looking for buying opportunity, for selling opportunities in this market. And if we want to sell, we need to identify our supplies. However, there is one problem here. We don't identify our supplies at random levels. We only identify our supplies at areas that led to either market shift, which is known as change of character, or break of structures. So if the level doesn't lead to any of these things, we don't identify it, because identifying random levels can actually lead you to take more unnecessary trade than taking profitable trade, and what we want is simply profitable trade. So for that reason, we are only going to identify market at levels at areas that led to key changes in the market. So for us to do that, first of all, let's identify our market shift, which some of you call change of character. So for me here is a level here. You can see here we had the first market shift to the downside. Now why is it a market shift? Here's a market shift simply because this is where the market took out the first low here. You can see here is the first low, and this was the point whereby the market took it out. So for that reason, here becomes the market shift. Now after this market shift, next up simply we have a break of structure right here. As it here, we have a break of structure right here. However, this one is somehow tight, so I like going for very vivid levels. So I'm just going to delete this, and then I'll come over down here to this vivid level here. So here is our break of structure. And then after that break of structure, our next break of structure is right here. Now you can see that what we've identified our market shift, we've identified our break of structure, and a break of structure again. So now the next thing we look at for here is simply we look out for our key levels, such as the supply levels that we are interested in. Because since the market is a downtrend, we are looking for supply levels so that we can only go short, because we don't want to go long when the market is selling. That would be the best mistake you can ever do as a trader, simply going short when the market is buying. It's like going short when the market is buying, and then going long when the market is shorting. So basically after this, now we need to identify our supply and demand levels, and these are very important levels because these are the levels we are going to trade from. So now it's time to identify our supply level. And to identify our supply level, remember I said that what we are only looking at areas whereby the market make decisive move that led to a change of character or a break of structure in the market. So now looking at this current market right now, let's take it from the top. Looking at this top side here is where we had the first supply level. Now when I'm identifying the supply levels, for my supply levels, I use the last bullish candle before the bearish candle that comes. So let me repeat it. I use the last bullish candle before the next bearish candle that follows. So for example, in this case, we all can see that one. So for those of you who don't understand my chart, the blue candles are the bullish candle, and then the gray white candles here are my bearish candles. So for me to identify my supply level, I have to use this last bullish candle here, before the bears actually came in. So this candle here will actually mark my supply level. So here is it. This becomes my supply level. And now secondly, I need to make sure that this particular level hasn't been mitigated. What I mean by this is that after the first three candles that leave this part, after this blue candle get printed, and then the followed by next two candles, after those next two candles, I don't need any other candle to actually tap into where this market is again. Like I don't need that level to be touched by any other candle again, because once it gets touched, it simply means that that level has been mitigated and I can't trade it again, because I'm trading the single candle supply and demand levels. So now here we have the level right here, and then next up is simply we are now waiting for the market to come to our key level, and then we'll look for our entry. However, that one is very far away, and there's still another level that we can identify before we can look into that one, and that level actually comes way down here, which is this other level right here. You can see there is another supply sitting right here that we can look into. Now let me zoom it for you to actually see. You can see that we have another supply right here before this major fall in the market. So for that reason, we have another level right here due to this bullish candle before this big bearish candle. So now basically, based on how I trade, I'm only looking at these two levels as it stands. Now why am I looking at only these two levels? Because these are the most vivid and clearest level that followed my system. Like if you look through the whole of here right now, you're not going to see any other level like this two. This one here, you can see that the bullish candle is clearly bigger than the bearish candle, meaning that what? There is no way I'm marking here as a supply level. Why? Because the bullish candle is way bigger than the bearish candle. What we are looking for is a scenario whereby the bullish candle is smaller than the bearish candle for our supply level. And if it's a demand level, we also need the bearish candle to be smaller than the bullish candle, which shows that what there is a momentum to that direction. So here, so once in a while, there is this thing that you need to mark known as a liquidity. So the liquidity could be equal highs. In this case, this is an equal high liquidity where we'll have a double top kind of formation. So the reason why it's called an equal high liquidity is simply because there are people that trade these double tops. So once the market come over to where this double top is, they will have this idea that the market is going to sell. So they will quickly place their sell limit orders around here with their stop losses probably at the top over here. Now when the market comes, you sweep out those stop losses and then you tap into your level, then you take your sell opportunity from there. Now what I'm saying here doesn't mean double top trading doesn't work. It works perfectly fine. However, once in a while, just as every other strategy, it also fails. That's why when these levels like this, we see them as liquidity. Based on how I trade, double tops are liquidity to me, double bottoms and all of those are liquidity to me, because there are a lot of limit orders around those areas with so many stop losses behind it that the market needs to sweep before it actually moves. So for this my strategy, I often call it the liquidity supply and demand strategy. We identify a fake level, a level that is likely to be fake. Yes, it's not 100% guaranteed, so I always say it's a level that is likely to be fake. We identify that level and then we identify our key place where we are interested in entering the market. So here is where we want to enter the market, and here we mark with a dollar sign. Here happens to be the liquidity level, which is a double top formation. Now this could be a supply level or a demand level in some situations. Like for example, for this other level right here could be where most people are going to tap into the area, because here is what we call a range supply. So this area is called a range supply. So this one also looks like what? A liquidity level. So we can also mark it as a liquidity level. But the reason why I did not mark the liquidity level here is simply because I'm only interested in selling from this particular level here for now, because this is where the market is currently closed at. It's after the market violates this level before I'll look into any other level. Now, all those aside, coming back to the strategy again, remember I told you that it's simple. We identify the trend, identify the level, and wait for our entry. Now, in this situation right here, we've gotten our trend, which shows that it's a downtrend. We've identified our supply and demand levels. Now, the next thing we need to do here is simply identify our entries. Now, this is where our entry confirmation pattern actually comes in. So now everybody out there have their own confirmation system that they actually use to enter. And for me, mine is simple. All I'm patiently waiting for here is that I'm waiting for this market to trade into this level without breaking it. I don't want it to go out of the level. I just want to tap the level and then give me a close outside on the 30 minutes. So basically, if this market tap here on the 4-hour time frame, then I'll drop down to the 30-minute time frame. Now the 30-minute time frame, I'm basically going to see if the market has given me a bullish close. So once it gives me a bearish close outside the level, I'm going to sell it immediately. So for example, let me say the market came in here and they gave me this structure of the 30-minute time frame. You can see it tap in and they give me this bearish close outside. So once I get that bearish close outside, I'm taking my sell immediately. Now I'm taking my sell from here, and then my stop loss will be right here. I'll only look out for the 30 pip margin. So you can see here, once this market closed bearish here, I will just take this sell and that's all. Now once I take this sell, I'm not doing anything again. The only thing I do next after taking this position is simply what we call trade management. And for trade management, I've covered it in my other video. You can go check it out. So let me just show you that particular video on trade management. So here, this video will be tagged in the video description. This video here which says best trade management strategy. Now this video breaks down how I personally manage my trade that are running live to make sure that as long as I've gotten into profit before, I always get something small from the market before it reverses against me. So no matter how the market moves, with this sort of trade management, your losses will always be way lesser than your actual losses that you targeted earlier on. So I advise you to watch this video on trade management. Now basically, getting back on our strategy is simple. As I already said, we identify our market trend to show that it's a downtrend. We identify our supply levels, and then we wait for our confirmation, which is the market taps into our level, gives us a bearish close, and then we take our sell position immediately. Now, if the market is an uptrend, then it's basically the opposite of what we are doing right now. So for example, it's like I have a setup on gold that I can use as an example here. So here you can see that I have a setup on gold. You can see the market is in an uptrend. I have my demand here. I have my demand here. I have my liquidity here. You can see the last break of structure. So I'm basically waiting for this market to come in here, give me my close, then I'll go in for a buy. Basically, I also have similar thing on silver that I'm actually waiting for. So this is a 30-minute setup if I'm not mistaken on silver. I mean a 1-hour setup. So I told you I trade in 1 hour, 30 minutes, and 4 hour. So it doesn't really matter. You can see on silver here as well. You can see that our market gave us a market shift here, break of structure here, and then it's pulling back. So basically, if it comes back to this demand level right here, I'm taking my buys, as simple as that. So basically this is all I have for you in this video when it comes to actually trading this strategy. This is a simple strategy that I can actually use to trade your prop firm, and then I promise you, provided I follow this strategy carefully, you are going to pass that prop firm when you follow every single rule clearly. So basically I have a setup here on GBP USD as well. You can see I'm currently waiting for it as well on GBP USD. So the market is approaching it. On Euro AUD, I have it at the top as well, waiting for it to come on. So basically once I do my setup, I just sit back and wait for them to trigger. You can see here I have GBP card. Okay, here I don't have a setup, here I don't have a setup, and then the rest setup are basically USD JPY. I have a setup that is far behind here. You can see, so I'm waiting for a major sell-off in this market before I actually get it. So basically this is all I have for you in this video about this strategy I can actually use to pass your prop firm. In case you don't understand anything, just let me know that in the comment section and I'm going to clarify it for you. So see you in my next video. Bye.